Okay, this one extra session, we are going to discuss a little bit about variances and the operating statements. But before, sometimes I just heard these comments from some students, not only from you, but there are some others as well, who have been talking about the sales variances. So let me first make the point clear that you have one which is called sales price variance. And for sales, you also have sales volume variance. And sales volume variance is not the full name. Actually, the proper name, you should not say sales volume variance. It should be sales volume profit margin variance or sales volume contribution margin variance, contribution variance. So this is the full name. Like sales volume should be either sales volume profit margin or sales volume contribution variance. And of course, we know that if you are using absorption costing, you talk about profit margin. If you are using marginal costing, you talk about contribution margin. So what is sales price variance first? Sales price variance actually, this is, the difference which results because of the changes in the sales price. For example, if you give some discount, you thought that you would sell something for $10, but then you sold it for $9. So any difference between the budgeted and the actual results because of the changes in the sales price, that is called sales price variance. And then you have sales volume. So you thought that you would sell 1,000 units, 1,000 units, but you sold only 900 units. So you actually sold 100 units less. So you have an adverse variance of 100 units, but this is in units. You must convert it into dollar value. So either you multiply it with the profit figure, or you multiply it with the contribution figure, whichever you need. If you need sales volume profit variance, so you will find out the changes in or the differences in the volume and you multiply it with the profit figure. Or if you are looking for sales volume contribution variance, so again you will find out the difference in the volume. Like my budgeted was 1,000, my actual is 900. So there is 100 units, and then each unit, how much contribution I am losing. So you must multiply not with the selling price, but with either profit or with contribution. So this is a very basic, quick recap. I already have explained this thing before in the lecture, but I just made a quick recap. Now, one question, a very typical question, and I think that sometimes students, they get confused on that. It says that a company uses standard absorption costing system. The following figures are available for the last accounting period in which actual profit was 270,000. So what they have given us, they have given us the actual profit. Now, you know that actual profit means actual profit. Based on your actual prices and based on your actual volume. For example, you might thought that you would sell 1,000 units at $10, but then you sold probably 1,100 units at $9. So we are talking about profit from this thing, where volume is actual and price is actual. So taking the actual numbers, your profit is 270,000. Then it gave us some information. It says sales volume profit variance, 15,000 adverse, sales price variance, 12,500 favorable. And when it says sales volume, so we see sales volume profit margin variance. It does not say sales volume contribution. It says sales volume. It does not say sales volume variance, first of all. Like I told you, there is nothing as sales volume variance. No, you should say sales volume, either profit or contribution. But because they are using absorption costing, so they don't use contribution, they use the word profit. So sales volume profit variance. What does that mean? It means that $15,000 you earned less as a result of selling lesser goods. The quantity, the volume was less. When it says adverse, it means that you sold less number of units. And then you multiply it with profit. If your profit, let's suppose profit per unit, let's suppose is 15, and this is 15,000, it means that you sold 1,000 units less than your budget. Okay, you don't need to go this much deep. I'm just trying to explain you. You know what, when you see some numbers, these numbers, they carry some picture. There is a picture at the back. Don't see it just 15,000. Just understand what does that mean. You should be able to make a picture of that. This 15,000 adverse means that I am losing 15,000 as a result of selling lesser number of units. And that lesser number of units multiplied by the profit per unit, this number 15,000 comes in. Sales price variance favorable. It means that 12,500 you made more profit because you probably increased your price. Your price went up. So because it's favorable. It is not adverse, it is favorable. Favorable means that you made more. And then total variable cost variance, then fixed cost expenditure variance, then fixed cost volume variance. 17,575 and 5,000. Okay, so we read the data. Then it says, what was the standard profit for actual sales in the last accounting period? Now, he's given you actual profit. And now he's asking you standard profit. Standard profit based on actual sales. Now, before I explain this question, I explained this before as well, but let me take this opportunity to revise it. There are three words which are in your mind. One is called budgeted, one is called actual, and one is called standard. These are three different words. These are three different words: budgeted, actual, standard. I have explained it before. I will repeat it again. Let me go to Excel. I want to, because this is the root here. This is the important thing to understand. Let's suppose that your budgeted selling price was $10. Budgeted selling price in dollars was 10. Your budgeted volume, or let me call it budgeted sales volume, budgeted sales volume is, let's suppose, 1,000 units. Okay, now then it says, based on that, what you can calculate, you can say that my budgeted sales are this much, 10,000. This was not given. Let's suppose that this information is not given. Okay, you calculated that. They told you that your budgeted selling price per unit is $10. Your budgeted sales volume in terms of units are 1,000 units. So based on these two information, you can say that our budgeted sales were $10,000. Then it says that actual sales volume was 900 units, and actual sales in dollars, actual sales were how much? Let's suppose that actual sales were 9,500. Okay, now what do you have? You have budgeted sales. You already have budgeted sales. You already have actual sales. So these two numbers you got. I told you that you need to understand the difference between budgeted, actual, and standard. So budgeted is what we planned. Actual is what we did or received or whatever. And what is standard? Standard is what it should have been based on standards. What it should have been based on standards. What does that mean? Now, if I say that standard sales revenue based on actual volume, this is the statement I'm writing. Standard sales volume based on actual revenue. Now, who will give me the answer for that? How much it should have been? How much it should be? If I say standard sales revenue, so budgeted sales revenue was 10,000. Actual sales revenue was 9,500. And standard sales revenue based on actual volume, how much it should have been? Can somebody tell me, please? How do I find out this one?
9,000.
Huh?
Sir, 10 multiplied by 900 units.
10 multiplied. It means that actual quantity multiplied by standard price. Standard price means the budgeted price, and that should be 900 multiplied by 10. So this is 9,000, right? This is what you call standard sales revenue. Are we clear on that?
Yes, sir.
Okay. Now I go back to the question again. So what it says in the question, now you can read it better. It says what was the standard profit for actual sales, which means the actual sales volume, but profit based on standard in the last accounting period. So this is the question we have to calculate. We have got 270,000 actual sales, actual profit is 270,000. But then we do have sales price variance and we do have sales volume variance. And then of course some cost variances as well. Now, when you read this question, I'm sure that this is in the book. Most of you people have already read it. And somebody asked me that they say that sales volume variance not needed. This is what Abid also asked me in the beginning of the lecture. Why they say that it is not needed? Abid, because you are using on actual sales. They don't ask you to calculate it on the budgeted sales on, they ask you to calculate on actual sales. So when you are calculating on actual sales, based on actual sales, which means that if my actual sales have been this much, how much profit I should have made? You are making profit on, let's see. You are calculating in the question they have given you. In the question, if you see that they have given you the profit, they have given you profit $270,000, right? And this is actual profit based on actual sales. This is actual sales. Now, what they're asking you to find out the profit, the standard profit based on actual sales. So this 270,000, it came from where? It came from, let's suppose $X per unit multiplied by number of units, right? This is how it came. Just go back, just think logically. Forget about how to say formulas or anything. Think about the logic. This 270,000 profit, it came based on what? It was based on actual units sold. Let me call it like this. Actual units sold. It was like this. Now, we know that this is actual units sold. Budgeted would be different. I don't know, whatever it would be. Now they're asking me to find out the profit, standard profit, again based on the actual units. So it means that I only need to consider this part, profit per unit. I don't need this one, because what they're asking me to do, they're asking me to calculate standard profit, because this profit X is not standard. This is actual profit. This is not standard profit. Maybe your standard profit probably is $10, $5 per unit, and your actual profit is only $4 per unit. So these might be different. This is based on actual profit into actual units. Now he asked me to calculate standard profit, like change this one to Y, but keep this one same. Keep this one same based on the actual sales. So now what I need to do, I need to make my equation. That profit I will calculate again per unit, which is my standard, how much it should have been based on the actual units. And that's why we said that sales volume variance is not needed, because question says based on actual sales. If the question says calculate standard profit on budgeted sales, then I would be needing this thing, sales volume variance, then I need it. Otherwise I don't. And I will use it, and we will calculate with the both options. So they say that calculate the standard profit for actual sales. Because we are calculating for actual sales, therefore volume variance, sales volume variance, we are really not interested, because we are not calculating that. So how much profit you made? You made 270,000. This is your actual profit. And then they ask you how much it should have been. Remember standard? It should have been. So this is, you have got this number, which is, say, fixed cost volume variance 5,000 adverse. 5,000 adverse means what? 5,000 adverse means that your profit was decreased by 5,000. Your actual profit was less, right? 5,000 adverse means actual profit was less. That's why you have adverse. So standard profit would have been more. So you add this 5,000. Do you understand this logic, why I'm adding 5,000? If you do not, please tell me now.
Sir, can you repeat it once more?
Now, this is my starting point, 270,000. What do I do with fixed cost volume variance 5,000? What does that mean? 5,000 adverse. What do you understand from that? What do you understand?
Profit will be less.
Not will be less, profit was less.
Okay.
It means that your profit 270,000 actually is less. When you get adverse variance means that actual profit was less, right?
No, sir. I'm so sorry. I didn't understand this.
When I say that there is, for example, fixed cost variance is 5,000 adverse. What does that mean? What do you
Profit
understand?
is the profit was 5,000 less.
No, first talk about fixed cost. It means that actual fixed costs were $5,000 more, right?
Yes.
If actual fixed costs are 5,000 more, then profit will be 5,000 less, right?
Yes, sir.
Adverse profit, adverse variances, they decrease your profit. Yes?
Yes, I got it. Yeah.
Now, they told us that my actual profit is 270,000. And there is a $5,000 fixed cost volume variance, $5,000 adverse. 5,000 adverse variance, if a cost variance becomes adverse, it means that my profit has gone down. Yani cost variance adverse means that cost has been more. Actual cost is more. Actual
Yes.
cost more means that actual profit goes down. If this
Yes.
adverse variance had not happened, my profit would have been more, right?
Yes, sir.
So actually this adverse variance has decreased my profit. So my standard profit should have been more. So I add this 5,000.
Oh, I understand now.
My standard profit should be 275,000.
Yes.
Yes or no?
Yes, sir. 100% understand.
If you talk about the next point, fixed cost expenditure variance 7,500 favorable. It means that your fixed costs were less and you made more profit. In reality,
Exactly.
actually your actual profit is more. Your actual profit, was increased by 7,500. In standard, it should have been less. If you have spent all the money as per the budget as per the standard, you should have spent more.
Exactly, sir. Yeah.
What should I do with this one?
So we should subtract 7,500.
7,500 we will subtract. And then comes 17,500 adverse. What do I do with that?
Sir, we will add this because it was supposed to be 17,500 less the cost, but it was more.
17,500 we will add.
Plus.
And then sales price variance.
So this is favorable, so yes, we will deduct it.
Sales price variance is favorable, I would deduct it.
Deduct it, yes.
And then what do I do with this 15,000?
275. So just yeah, sir, we will add this because this is adverse sales volume profit variance.
Oh, sir.
No, we will just ignore it.
Oh, okay,
The
sir. Could you
last
please
one
tell me
you will
why?
ignore. Why you will ignore? Because you are making a calculation based on actual sales.
Oh,
So this is profit. This profit 270 I'm taking from where? From actual or budgeted?
from actual.
From actual. So
Yes,
and this
yes.
is also actual. So this variance I will ignore.
Okay, so what you're trying to say that when we are comparing volume and actual, then volume is not matter. Only actual figures will matter, right?
Yes, because volume will not matter because they say, tell me what it should have been based on actual.
Oh, yeah, yeah, yeah. Fine. Thank you, sir.
No,
Understood.
I will tell you something like this. Wait, we will not stop it here because I know that this point can be illustrated better. Let's see like this. Do you people see the Excel?
Yes, sir.
This is my budget. This is my actual. This is my sales price. I will explain it you. This is your labor. Let me call it like material, labor, variable overhead, and fixed overhead. So my selling price is $12 and my material is 6, labor is 3 minus 2 minus 2, and I get my profit. Okay, I just put big numbers. Let's put it -4 and let it put -2, or maybe we can increase this number as well. So this is my budgeted profit. Everybody is there, everybody is listening me,
Yes.
watching me.
Yes, sir.
Yes, sir.
Okay, I'm trying to explain you in such a way that you should never forget again. And you should be able to explain anyone else as well. Okay, so you have budgeted sales volume. And budgeted sales volume is, let's suppose, 1,000 units. And you will have budgeted profit. Budgeted profit is this one. Okay. I will change these numbers because something came to my mind. Let's actual is this one minus 15 minus 10 minus 5 minus 4. I put it here and I put it here and here. 16,000. Now I'm gonna put here 10,000. I will show you why I'm playing with these numbers. Like this. Okay. Minus 17. Okay. This is what they have given you in the question. What was our question? I just created some hypothetical data. You go back to the question. What was the question? Actual profit was how much? They said that actual profit is
270.
270. So I just changed my numbers in order to match that thing. Okay. So actual profit I made 270. And if I take these numbers here, and I'll just make some changes. I'll make just some changes in. I'm just playing with the numbers because numbers will help you understand better. And probably it was -8. So maybe your budgeted profit is 290. I don't know. They did not tell us these numbers. They only gave us this number. Now, what does the question say? The question says, calculate the standard profit based on actual sales. Okay. How would you calculate this thing? If I don't give you the variances, they gave you the variances in question. I'm not giving you any variances. I'm just giving you this question, this requirement. Can you answer me this question? Calculate the
Sorry.
standard profit
Yeah.
based on
14.
actual sales. What would you do?
14.5
14.5
actual
multiply
by 20,000 units.
20,000. So whether it is 20 here or it is 18 here, it does not matter. Maybe actual budgeted sales volume was 22,000, let's suppose. Budgeted sales volume may be 22,000. But they told me to calculate, to tell me the standard profit based on actual sales. Standard profit means the budgeted profit multiplied by the actual sales, which is 20,000. And therefore, that's why we ignored that volume variance. So there is a volume variance, but we ignored. So what we did, we only calculated the difference of these two multiplied by this one. Now there are variances actually. If you see here, you have variances. These are your variances. How we calculate? This is my variance. For example, my material cost should have been 18. It is 17. So there is $1. Sorry, I should take this one. Minus this one. There is $1 favorable variance because you budgeted 18, but you spent 17. It is 1. Then you copy paste all of them, these ones, and then you multiply it with the actual quantity. How much is actual quantity? 20,000. You multiply them with the actual quantity. This is your total variance. This is your total variance. Okay. When you make a total of that, these are your variances. Your material price, your material variance, labor variance, variable overhead, there is no variance, fixed cost I ignored. This is how you do it. So what you are trying to do in this particular situation, what you are doing here, because the question, it does not ask you to find out, the question gave you these variances already. What the question did, they gave you that your fixed cost variance is this much, your variable cost variance is this much. They gave you these variances, and these variances are actually result on this one, on this 14.5 and 13.5. So you just took care of the variances. You said, okay, I will take the actual quantity multiplied by these variance, multiplied by this price, because they did not give you the price. So you added subtracted variances. Either in the question, they tell me individual prices, or they can tell me the total variances. In the question, in the data, they gave you the total variance. If you pay attention, you said that this is how much my profit it should have been. If you come back here, they did not give you individual data. They tell you that there is a variable cost variance total 17,500 adverse. Just like if I consider on Excel, this is my variable cost variance, whatever it is. So I add, subtract these ones. So because in this particular question, they asked you to calculate this thing based on actual sales. Now, if they ask me, calculate the standard profit based on budgeted sales. Then what you do? Then you should be taking care of that sales volume variance also. Whatever your answer was, then you should say, if they say calculate it on budgeted sales, in that situation, this variance, sales volume variance 15,000, you should include that as also. And if you have to include, what you would have done, add or subtract?
Add.
Add back. You should have added back. If they only tell you that calculate standard profit on budgeted sales, then you should take this care. You should add this number also. Understood?
Yes, sir.
Yes, sir.
Okay, now there was one question that what we do with the marginal costing. When you make marginal costing statement, you ignore your fixed cost volume variance. If you pay attention, here we took care of this fixed cost variance. But if you are making the same thing, if they tell me that the company does not use absorption costing, but company uses marginal costing. So in marginal costing, there is no fixed cost variance, because in marginal costing's income statement, if you remember, you subtract all of the fixed cost. You do not absorb fixed overheads into the costing. You add them straight. So in marginal costing statement, fixed costs are always ignored. For example, we see one question here, one short question we will do, and then I'll explain. For example, this is one short question. It says that a company uses standard marginal costing. Last month, the standard contribution on actual sales was $10,000, and the following variances arose. Variable cost variance 2,000 adverse, sales price variance 500 adverse, and sales volume contribution variance $1,000 adverse. So what was the actual contribution for last month? So you take your standard contribution 10,000, and then this sales price variance you did, and you said total variable sales cost variance is minus 2,000. The sales volume contribution variance we just ignored. Why did we ignore that? Why did we ignore that sales volume contribution?
Because, sir, it was to find from standard contribution on actual sales.
Yes, because on actual sales, and here also it says actual. So if we are talking about actual, so volumes are ignored, just like in previous question. And now let's see one more question for the fixed cost variances. So if you pay attention, like in previous question, actual, here it is also actual. So you ignore the volume. But you see here.
But if it is budgeted contribution, then we will consider.
Then you should have considered.
Okay.
Then one more question for fixed cost. A company uses standard marginal costing. Last month, when all sales were at the standard selling price, which means that actual selling price and standard selling price is same. The standard contribution from actual sales, standard contribution, which means your budgeted profit per unit, but actual sales unit, were $50,000, and the following variances arose. Total variable cost variance 3,500, fixed cost variance 1,000, sales volume contribution variance 2,000. So what was the actual contribution for last month? So because this is from actual sales and they ask you to do the actual, so this volume thing you will straight away ignore. Because of this actual and actual, volume you will ignore, just like you ignored in previous questions. And this fixed cost thing, you also ignore this because you are using marginal costing. So in marginal costing, fixed cost is also ignored. So what you need to do, only 50,000 and this variable cost. That's all. No? Understood?
Yes, sir.
Any comments, questions here, please? Okay. So these are actually pretty simple examples. We didn't do anything difficult because the purpose is not to do difficult questions. Now at the moment, I'm just trying to explain you the concept, and then we can do some difficult questions as well. Now, if you have any difficult question, any particular problem from the kit, you can ask me. Which question, I mean, you were doing and it gave you trouble, we can go to the kit and do that thing together. Okay, so your question, this question, you shared this question from Kaplan. It says that QRL uses a standard absorption costing system. The following details have been extracted from its budget for April 2007. Fixed production overhead cost 48,000 and production units 4,800. In April 2007, the fixed production overhead cost was under absorbed by 8,000 and the fixed production overhead expenditure variance was 2,000 adverse. What was the actual number of units produced? Okay, so we know that 48,000 is your total fixed production overhead cost budget. Units are 4,800, so you assume that your OAR should be $10 per unit. And then it says that in April, the fixed production overhead cost was under absorbed by 8,000. And the fixed production overhead expenditure variance was $2,000 adverse. Expenditure variance, fixed production overhead expenditure variance was 2,000 adverse. So 46,000 and under absorbed. 46,000 was there and it should have been 54. 5,400. D should be the answer.
Okay.
Is it not D?
Just let me check.
It should be D.
$314. Sir, it is C. 4,200.
Expenditure variance was favorable or adverse? Go back. It's the same logic. I just probably missed on something. Go back to the question. 314. It's one of the easiest questions actually. I mean, I didn't even use calculator. You also don't need to use calculator. It is a question which is done without calculator. Wait a minute. Okay, so yeah, I'll explain you. It is adverse. I thought the other way. Wait a minute. See, when you see such a question, the first thing is you find out what is your OAR. Your OAR is $10 per unit. Now, in this question, they told you that your budgeted cost was 48,000 and you had a fixed overhead expenditure variance 2,000 adverse. 2,000 adverse. Remember fixed cost expenditure variance, I told you, you don't do any calculation for expenditure variance. Expenditure variance is the difference between the budgeted fixed cost and the actual fixed cost. That's all. The expenditure variance is the difference between budgeted and actual fixed cost. Your budgeted fixed cost is 48,000 and your expenditure variance is 2,000 adverse. 2,000 adverse means that you spend $2,000 more than your budget. You spend $2,000 more than your budget. Budget is 48. It means that you actually spent 50 because it said that you spent 2,000 more. I thought that it is 2,000 favorable. My mistake. 2,000 adverse. It means that my actual expenditure is $50,000. Now this $50,000 is my actual, and it says that you have under absorbed by 8,000. Now what is under absorption? Under absorption means when actual overheads are less than the absorbed overheads. Under absorption, if you remember, when actual overheads are less than the absorbed overhead.
Yes,
So
sir.
it means that 50,000 minus 8,000, you under absorbed. So it means your absorbed overheads are 42,000. 50 minus 8, 42. Absorbed overheads are 42. Absorbed overheads are less. And then 42,000 units, $42,000 divided by $10 per unit, because you know that your OAR is $10. 48,000 divided by 4,800, your OAR budgeted overhead per unit is $10. So you are absorbing $42,000. 42,000 divided by 10, it gives you 4,200. C should be the answer.
Yes, sir.
I just added in the very beginning. What I did, I subtracted 48 minus 2. I made it 46. That's why the answer was wrong. So this question, this type of question, because they actually do not want you to use calculator, and that's why they give you such a simple number, 48,000, 4,800. You immediately know that it is $10. And then they don't tell you 2,325, 8,195. They are not doing it. They're saying 2,000, 8,000. So you can see it and just add, subtract it. 48, variance is adverse, it becomes 50. It is under absorbed. 50 minus 8, 42. 42,000 is my absorbed overhead. 42,000 divided by my OAR, it gives me the number of units. Because what is the formula for absorbed overhead? Absorbed overhead is
OAR.
Actual units into OAR. So absorbed overheads are 42,000 is equal to actual units X. I do not know, OAR 10. Remember the formula for absorbed overhead?
Yes, sir.
So absorbed overhead formula is absorbed overhead is equal to actual unit into OAR. Absorbed overhead, I can find out it is 42 because it says it is under absorbed. Under absorbed means absorbed overheads are less than actual. Actual is 50, absorbed is 42. 42,000 is equal to X multiplied by 10, and then X is equal to 42,000 divided by 10. So this, you picked up the question. It is a common question. This type of questions are also in BPP kit. It is also in Kaplan. It is one popular question because it gives you a way of thinking. It is not a tricky question or very technical question. It is just like your mental exercise with absorption costing. How do you manipulate these equations of absorption costing? How do you, maneuver these numbers? That's all. It's not very difficult. And the numbers they give you like this, it means that they want you, don't touch calculator, do it without calculator.
Sir, may I ask you something?
Yes, please.
Sir, just like 20 minutes ago, I went for namaz, so I missed something in the middle. I just wanted to ask that have we done the marginal standard operating, or are we, progressing towards it?
We talked about marginal as well. I will put up the recording.
Okay, good.
Right.
Yes, please.
In operating statements, what about if we learn the pro forma for absorption and marginal, so that it can get easy for us to?
Yes, that's exactly what I was talking about.
Now, ask me again. I didn't get it.
Sir, in BPP text, there is pro forma for absorption operating statement and marginal operating statement.
Yes.
So if we can go through, understand it in our mind, keep that picture in our mind and do the questions, is that way safe? Or
Yes, you can do that. Why not?
okay, sir.
But you need to make few operating statements by yourself. Otherwise, you will forget the performer.
Yes, sir.
Okay. Anything else?